Hi everyone. So I'm always getting asked what DT cycle I trade or what expiration do I trade and sell options on. And the answer is, it just depends really. Ideally, I want to stay at 45 days and less. But, it depends on what's going on with the price of the underlying of the commodity. And I'll show you exactly what I do to figure out what cycle I'm supposed to trade in this specific, in every specific case. So this will be the why, the how, and you'll see it's pretty easy to figure out. So let's begin by, and we'll do a few examples. So we'll do crude oil, we'll do soybean oil, I believe, and we'll look at natural gas. So right now I'm looking at crude oil, and you can see the price is kind of moving sideways. So this is something that I would want to potentially look at. For example, if we have something like gold, which is really directional, so there's no way for me to, to be able to trade it neutrally, which again, I only trade neutral. Well, for the most part, but this is specifically for a neutral trading approach. So crude oil, you can see is going pretty sideways. So let's see what would have been the ideal, I guess, range for us. So something like this probably would have been, or even like this would have been an ideal range for our stop losses. Now, based on what's going on in the graph, I marked what I think is the ideal stop losses, or at least cover this over here. So if we can do this, it means the price. If we can get this kind of stop losses, it means the price have been moving within this range since beginning of September. Right now it's almost April, so it's quite a few months. I'm looking for at least about 3 months. 2 to 3 months. 3 months is definitely ideal, but again, it depends on the situation, but usually 3 months is pretty good. If the price have been moving for about 3 months in the range that you selected, then that's really good for neutral trading. From here, so we're looking at the, this is the June 2025 contract. So let's see what we have. So we have 49 days to expiration. So let's take a look and see what kind of range do we get to our stop loss when we look at this DT at 49, which is for me probably the ideal days to expiration. And again, I'm just selling a normal strangle here. Our stop loss is at 50%, so we have about $1,700 in credit. So our stop loss will be $850. So let's zoom in a little bit. So let's see what are theoretical stop losses at $850. So it's 64.74. So 64.74, which is not too bad. And on the call side, 850 will be 73.66. So 73.66. So obviously, on the downside, it's kind of okay. The top side, not good at all. It's cutting through. So this is not gonna be the cycle for me to trade. And from this point on, I will just go on and I'll go to the next cycle, which is 81 days to expiration. Now this is the July contract. So I need to make sure that we are going to crude oil and to the July contract. And we'll put this right here. So let's see what kind of range we get for 81 days to expiration. So I'll go ahead and do about the same thing. Sell about delta. I sell anywhere from delta 20 to 22. Doesn't really matter too much. So let's go ahead and do it. And we have about, 2250 in credit. Let's round it up to 2300. So we're looking at a stop loss when the position is down about $1,150. So it's a stop loss of 50% of credit. So 1126. So it will be at 62.68 on the bottom. So 62.68 on the bottom, and on the top side it will be, let's see here, 74.58. So 74.58. So that's perfect for us, right? So this is pretty good stop loss. Now ideally I would maybe want to push the put side a bit up and have a bit more room on the top, but overall, this is the cycle that I'm going to trade. This is the lowest DTE cycle that gives me approximately the range that I want, where the price have been moving within this range for at least 3 months, which is the ideal number for me. All right, so this is how I figured out what cycle to trade in crude oil. Now let's take a look at soybean oil. So ideally, the range that for us to be able to open a position safely will be something like that, give or take, or maybe something like this. What is it, November? So beginning of November. So we have quite a few months. So this will be perfectly fine with me in this case. So let's see what can we get for the or what expiration cycle can we go for. And again, this is exactly what I do myself. I'm usually I can eyeball it pretty easily and kind of know what DT we need based on the price movements. But if you're not sure, this is exactly how I would go and do it. So I know for a fact 57 days to expiration is it's not going to be enough. But any case, let's just go over it. But 57 days will definitely not give us the needed amount of credit to be able to have a good enough stop loss. So I'm going delta 22 here, give or take. We have a credit of about 650, so 325 will be the stop loss. So 325 will be at 0.42. Now this is a bit tricky because it changes. So this is 0.425, give or take. And this is the July contract. Let's see, are we the July? Perfect. So 0.425, yeah. So you can see I already know that the stop loss at the bottom is not going to be good. The top side will be about the same thing. So we can already rule it out because the bottom is not where it's supposed to be. So let's go ahead and take a look at the 85 days to expiration, which is still it's the same futures expiration in July. Let's go ahead and sell here delta 21.6 and delta, what is it? Delta 20.4 should be okay. So right now we have $850 in credit, so we're looking at 425 for the stop loss. So let's look at 425. 425 will be right here, so 0.41. So it's actually 0.41, almost 0.415. 0.41 and almost 5, so right here. So this is a pretty good stop loss here. Let's see what can we get on the upper side. So 425 and will be 0.48. So 48 begins here. This is 48 and a half, and this is almost 49. So it will be almost at 0.49. So we have 48 and almost at 0.49. Perfect. This is the cycle to trade here because it covers exactly the range that we're looking for. I'm pretty happy with it, and this cycle is the one with 85 days to expiration. Now, sometimes 57 days to expiration will do the trick. Right now in the market, there's no good example for that, but I can go back in time and show you approximately, let's see, somewhere like here. This is natural gas, and here the ideal range will be probably this range. And I can tell you right now, especially because this is at the end of summer, it's in October, but I can tell you right now that this range would have been pretty good. And we have July, August, September, and October. We have 4 months of range here, and this is a pretty tight range for natural gas. So I know for a fact the days to expiration here would have been 50 or under, and it would have provided the range that we need. Now we can always be go a bit safer if you want and trade like 80 days, 90 days to expiration all the time, but it's all about being as efficient as possible, obviously, and kind of see what's going on in the market. So this is how I know what days to expiration for me to choose to trade. Usually I want to stay at 45 days and less because theta is the biggest there, but again, you need to take whatever the market is giving you, right? So this is basically the most important thing, and be flexible because all those days to expiration, different deltas, this is just, tools in your toolbox, and you need to see, look at the patient, which is the graph, and see what do we need to do to be able to profit from it, from the price movement, right? So this is as simple as that. Hopefully it made a lot of sense to you. I think this is as simplified as can be. The most important thing for me is always my range to the stop losses, and this will always be the number one thing. And if it works, then if the DT, the expiration cycle you're looking at is giving you the right amount of range based on what you see on the graph, then you just go for it. Then this is a pretty good trade which has a pretty high chance of succeeding. So that's it about this video. Pretty quick video, and thanks so much for watching, and I will catch you in the next one.